Brent just broke $90. But here's what every oil trader needs to know right now. The Strait of Hormuz is effectively closed. Only 6 vessels passed through on August 9th. That's not a normal market, that's a geopolitical shock. And today we have 4 major events stacked together. Watch my full breakdown for the exact levels I'm trading. If you're trading oil, you cannot afford to miss this video, especially the trade cards attached at the end of the video. The Strait of Hormuz is a choke point for roughly 20% of the world's oil supply, and right now, it's effectively shut. I've been trading through geopolitical crises for 2 decades, from the Iraq War to the Ukraine invasion, and I can tell you this. When a major shipping lane becomes a bargaining chip, markets don't just react. They convulse. Brent crude broke above $90 this week, and WTI is knocking on the door of a significant breakout. But the real question isn't whether oil goes higher. It's whether today's data storm gives the bulls enough ammunition to punch through resistance or triggers a violent shakeout that catches the over-leveraged crowd completely off guard. I'm the founder and lead analyst of Alpha Market Meridian, and in this video, I'm going to show you exactly what I'm watching across the crude oil complex. I'll give you the technical levels that matter, break down the fundamental drivers that are moving price, and deliver 2 scalping setups and 1 swing trade with precise entries, stops, and targets. If you're trading oil this week, you need to understand what's happening beneath the surface. Let's get into it. Here's my instant verdict on crude oil for the week ahead. I'm cautiously bullish with a bias toward buying pullbacks rather than chasing rallies. The geopolitical risk premium is real, but the technicals are flashing overbought warnings that any experienced trader has to respect. WTI has rallied over 4% in the last week alone, and Brent is on track for its 5th consecutive daily gain. That kind of momentum can't be ignored, but it also means profit-taking is lurking at every major resistance level. For WTI, my key invalidation level is the 81.17 support. As long as we hold above that, the bulls remain in control. If we break below it with conviction, the entire structure shifts and we could be looking at a move back toward the $80 to $81 area. For Brent, it's the 85.68 level. Hold that, and we are targeting the 91.33 to 92.11 resistance zone. Break it, and we could see a rapid flush toward the 84.70 area. Now, here's the thing that stands out to me. I've seen this exact setup before, in August 2022, during the last major energy shock. Back then, the market was overbought, sentiment was euphoric, and everyone was calling for $100 oil. And what happened? A violent correction that shook out the weak hands before the real rally began. We could be in a similar situation here. The difference is that this time, the geopolitical catalyst is more persistent, and the supply picture is more constrained. But the psychology of the market is the same. Before I go deeper, drop a comment below. Are you bullish on oil this week, or are you looking for a short opportunity? Let me know where you stand. Let's start with the weekly chart, because that's where the big picture is really coming together. Brent crude is trading in a clear bullish trend, having broken above the $90 psychological level after consolidating for much of the year. The weekly close last week was up over 3.5%, and the momentum indicators are confirming the strength. The ADX is showing a strong trend, and the MACD has confirmed a bullish crossover to the upside. What I'm watching here is the $94 resistance level. That's the next major hurdle, and if we can clear that, we are looking at the 97.80 level as the ultimate target. WTI is telling a similar story, but with a slightly different technical profile. The weekly chart shows a sharp rally from the July lows, with price now approaching the 89.24 resistance level. That's a key level that's held multiple times in the past, and it's going to take some serious buying pressure to break through. The weekly pivot is around the $80 to $81 area, and as long as we stay above that, the bullish structure remains intact. Moving down to the daily chart, this is where the overbought conditions become more apparent. The RSI is approaching overbought territory on both Brent and WTI, and the Williams %R is flashing similar warnings. That doesn't mean the rally is over, but it does mean that any negative headline could trigger a swift pullback. What I'm looking for is a healthy consolidation or a moderate pullback to let the indicators reset before the next leg higher. On the 4-hour chart, we are seeing the real battle taking shape. WTI is attempting to break above the descending trend line that's been in place since the $94 high. This is the same trend line that has rejected price multiple times, and breaking it would be a significant bullish development. Brent, on the other hand, is consolidating near the highs, which is actually a constructive sign. In my experience, consolidation near resistance often leads to a breakout, rather than a reversal. I saw this pattern back in March 2024, when gold consolidated for 3 weeks above $2,000 before exploding higher. It's the same psychology. The market is digesting gains and building energy for the next move. On the 1-hour chart, we are range-bound with a bullish bias. Prices are consolidating near recent highs, and the volatility is picking up as we approach today's key events. The ATR is around $3.50 to $4 on WTI, which is elevated and suggests that wide intraday swings are likely. That's not a market you want to be over-leveraged in. I've seen traders get wiped out in moves like this because they didn't respect the volatility. Set your stops, size down, and be patient. Now let's talk about what's actually driving these moves, because the technicals are just the expression of the underlying fundamentals. And right now, the fundamentals are dominated by one thing: the geopolitical situation in the Strait of Hormuz. Here's what's happening. Senior Iranian officials have said that the Strait will not reopen unless their conditions are met, which include lifting sanctions, ending the naval blockade, and compensating for military losses. That's a non-starter for the United States, especially with Donald Trump's administration taking a harder line. Pakistan's defense minister has suggested that the US and Iran are close to some arrangement, but Washington has since made it clear that new tough demands are on the table. The result is a stalemate that shows no signs of breaking. The impact on supply is staggering. Only 6 vessels passed through the Strait on August 9th, compared to the normal traffic of around 18 to 20 vessels per day. The U.S. Energy Secretary has said that average exports over the past 7 days were about 9 million barrels per day, which is a significant reduction from normal levels. This is not a speculative risk premium. This is actual supply being taken off the market, and it's not just the Strait of Hormuz. We are seeing military clashes escalating across the region. U.S. forces fired on vessels attempting to break through Iran's port blockade. The Houthis have claimed an attack on Saudi Arabia's Jazan refinery. A Saudi vessel was attacked in the Bab el-Mandeb Strait. This is a multi-front geopolitical crisis, and it's putting upward pressure on prices from every direction. But here's the thing that I want you to pay attention to. The market is already pricing in a significant geopolitical risk premium, but that premium could expand dramatically if the stalemate continues. Jeffries has noted that if the stalemate continues into next week, prices would not be this moderate. And Capital Economics has warned that if Hormuz remains closed, the fourth quarter could reach a tipping point. That means significantly higher prices. Now, today is absolutely critical because we have 4 major high-impact events converging. At 1600 Beijing time, we have the IEA Monthly Oil Market Report, which will focus on global stocks and demand forecasts. That's followed by the OPEC Monthly Report, which will address production and the supply-demand balance. Then at 21:30, we have US July CPI data, which is expected to come in at 3.4% year-over-year, with core CPI expected at 2.5%. And finally, the EIA weekly crude oil inventories are expected to show a draw of 1.3 million barrels, after a build of 2.479 million barrels last week. Any one of these events could move markets. All 4 of them happening in the same day creates a perfect storm of volatility. This reminds me of the March 2020 session when COVID headlines and OPEC news hit simultaneously, and oil futures traded in a $20 range. I was on the desk that day, and the only reason I survived was because I had cut my position size by 70% before the data hit. That's the lesson here. Don't be a hero going into these numbers if we get a bullish outcome, meaning the CPI is mild and doesn't trigger rate hike fears, the inventory draw exceeds expectations, and the IEA and OPEC reports confirm the supply deficit, we could see Brent push toward the 91.33 to 92.11 resistance zone, and WTI toward 84.84. If we get a bearish outcome, an unexpected breakthrough in the Hormuz situation, or a CPI beat that strengthens the dollar, we could see a sharp pullback toward the support levels I mentioned earlier. Here's my personal take. I think the geopolitical situation is worse than the headlines are suggesting. The market is still pricing in a resolution that I don't see happening anytime soon. I've been trading long enough to know that when the US administration and Iran are this far apart, negotiations don't resolve quickly. I'm positioned for the stalemate to continue, and I'm looking for buying opportunities on any significant dip. Now, let me pause here and ask you a question. Drop a comment below. Do you think the Hormuz situation resolves in the next 2 weeks, or do we see this drag on into the fourth quarter? I want to hear your perspective. Alright, let's get into the setups I'm watching. These are the exact trades I'm considering, with precise levels and risk parameters. Remember, these are my personal trade ideas based on my analysis. You need to do your own research and manage your own risk. Setup 1, WTI Scalping Long. The first setup is a WTI scalp on the long side. I'm looking for a pullback to the $81.50 to $82 area to enter a long position. The catalyst for this trade would be WTI holding above the 81.17 support level, combined with bullish news from today's events, a larger than expected inventory draw, or a CPI print that supports a risk-on environment.my entry would be at $81.50 to $82, with a stop loss at $80.80. That's just below the key support level. My first target is $83.50, which is a near-term resistance level. My second target is $84.84, which is the major resistance that I've been watching. The risk-reward ratio on this trade is excellent, risking roughly 70 cents to make around $2 on the first target and $3 on the second target. That's a better than 2-to-1 reward-to-risk ratio, which is exactly what I look for in a scalp. The invalidation for this trade is a break below $80.80 with no bounce. If we see that level get taken out on heavy volume, I'm out of the trade completely and I'm looking for short opportunities instead. Setup 2, Brent Scalping Short. The second setup is a Brent scalp on the short side, but this is a lower conviction trade that I would only take if we get clear bearish catalysts. I'm looking at the $90 to $91 area on Brent as a potential short entry if resistance holds and we get bearish news. Perhaps a stronger than expected CPI that strengthens the dollar, or an unexpected development in the Hormuz negotiations. My entry would be at $90.50 to $91, with a stop loss at $92. My first target is $88, and my second target is $86.50. The invalidation is a break above $92, which would signal that the bulls are still firmly in control and the short is wrong. I'll be honest with you, I don't have strong conviction on this short setup. The geopolitical tailwinds are too strong, and I think any downside is likely to be bought quickly. But I always include both sides of the market in my analysis because you need to be aware of the risks and opportunities. This trade is really about managing risk on existing long positions, rather than trying to catch a falling knife. Setup 3, Swing Trade Bullish Pullback. Now, this is the setup I'm most excited about. This is the swing trade that I've been positioning for over the past week, and it's the one I have the most conviction on. I'm looking for a pullback to buy, not a breakout to chase. This is what we call buying the dip, and in a trending market with strong fundamentals, it's the highest probability strategy. For WTI, I'm looking to enter between $80 and $81.50. For Brent, the entry range is $85 to $86.50. The stop loss for WTI is $78.50, and for Brent it's $83.50. I know that's a wider stop than the scalping setups, but this is a swing trade, and I need to give the position room to breathe. The volatility is high, and a wide stop is necessary to avoid getting stopped out on noise. My first target for WTI is $85, and my second target is $89. For Brent, my first target is $90, and my second target is $94. The risk-reward on this trade is exceptional. WTI is risking about $2 to make $4 to $9. Brent is risking about $2 to make $4 to $9. That's a 2-to-1 to 4-to-1 reward-to-risk ratio, which is the kind of asymmetric opportunity that makes sense for a swing trade. The logic behind this trade is straightforward. The Hormuz stalemate is persistent, inventories are falling, and the EIA has raised its oil price forecasts. The supply deficit is real, and the market is going to have to price that in eventually. The only question is timing and volatility. I'm willing to wait for a pullback to get long, because I don't want to chase this rally. I've seen too many traders get caught buying the top after a sustained move. The patience to wait for the pullback is what separates the amateurs from the professionals. Let me pause here and give you a quick interaction trigger. If you're bullish on oil in the next 3 to 5 days, type bullish in the comments. If you're bearish, type bearish. And if you're staying on the sidelines because of the volatility, type sidelines. I'm genuinely curious to see what the community is thinking. Before I give you my final verdict, let's talk about risk management. This is the part of trading that gets ignored in the pursuit of profits, but it's the single most important element of long-term success. Right now, oil is in a high volatility environment. The ATR is elevated, and the confluence of 4 major events today means that wide swings are not just possible, they're likely. I've seen traders get caught offside in conditions like this, and the damage can be significant. I remember a trade in 2016, during the OPEC production cut negotiations, where I got caught in a $6 range in a single session. I had sized my position for a $2 range, and I got squeezed out of a profitable trade because I didn't respect the volatility. That lesson cost me money, but it taught me something invaluable. You have to size down, you have to set wider stops, and you have to be willing to stay out when conditions are uncertain. Here's my practical advice. If you're trading oil today, reduce your position size by at least 50% from what you would normally trade. Use wider stops to account for the volatility. And don't hold positions through the major data releases unless you're prepared for a gap move. You can always re-enter after the data, but you can't get back the capital you lose on a bad trade. I'm also watching the dollar carefully. If CPI comes in hot and the dollar strengthens, that's a headwind for oil. And I'm watching the headlines from Hormuz constantly. That's the wild card that could move markets in an instant. I have a Bloomberg terminal open, and I'm running keyword alerts for Iran, Hormuz, and Strait. You should be doing the same, or at least following a reliable newsfeed. So here's my final verdict on crude oil for the week ahead. I'm cautiously bullish, but I'm not chasing this rally. I'm waiting for a pullback to the 81.50 area on WTI and the 85 to 86 level on Brent to establish long positions. The geopolitical risk premium is real, the supply picture is tightening, and the technicals suggest that higher prices are ahead. But the overbought conditions and the data storm today mean that the path higher is likely to be volatile and uneven. The key level to watch is WTI's 81.17 support. As long as we hold above that, the bulls are in control. If we break it, everything changes and I'm reassessing my bullish thesis. For Brent, it's 85.68. That's the line in the sand. I'll be watching today's CPI and inventory data closely, and I'll be looking for that pullback to get long. If I see the right setup, I'm ready to execute the swing trade I outlined earlier. I've got my levels ready, my stop set, and my conviction clear. Now it's about execution and patience. Don't forget to check out my weekend market recap and my Friday analysis for a deeper dive into the broader market picture. I link to those in the description below. And if you haven't already, smash that like button, subscribe to the channel, and hit the bell so you don't miss my next video. I'm publishing fresh analysis every week, and you don't want to be left behind. Thank you for watching Trade Meridian Decoded. I'll see you in the next video. And remember, in the markets, patience is not a virtue. It's a strategy. Trade safe.